And I'm also going to ask Saudi Arabia and OPEC to bring down the cost of oil.
Trump's request for Saudi Arabia to boost oil production has been met with resistance. But why is Saudi Arabia reluctant to comply, and what does this mean for America's energy future? Let's take a closer look at Trump's oil strategy and its implications.
Right now, the price is high enough that war will continue. You got to bring down the oil price. You got to end that war.
Trump's approach to oil is built on pressure, and he has been vocal in urging OPEC, especially Saudi Arabia, to boost production. His reasoning is straightforward. More oil supply leads to lower prices, which could help curb inflation, a pressing economic concern. However, Saudi Arabia isn't budging, and they have strong reasons for resisting. When Trump advocates for increased drilling in the U.S., it sounds appealing. "Drill, baby, drill" is a catchy slogan. But the reality is far more complex. American oil producers have become cautious after the financial turmoil caused by overproduction during the shale boom. Now, their priority is financial stability and returning profits to investors rather than ramping up production. This disconnect between Trump's push for more oil and producers' reluctance creates a challenging situation. Saudi Arabia has a vested interest in keeping oil prices high. It's the backbone of their economy. Producing more oil would drive prices down, reducing their revenue. To maintain economic stability, they need oil prices to stay around $90 per barrel. But their reluctance isn't just about economics, it's also about power. By controlling oil supply, Saudi Arabia strengthens its influence in global markets. They won't simply increase production because Trump asks them to. They are playing a strategic game with long-term stakes. Moreover, they are not concerned with U.S. inflation or international conflicts. Their focus is on their own economic stability and prosperity. OPEC, the powerful coalition of oil-producing nations, plays a crucial role in controlling global oil supply and prices. Their decisions have far-reaching consequences for the world economy. When OPEC cuts production, prices rise. When they boost production, prices fall. This leverage makes negotiations with OPEC complicated. Each member has its own economic priorities, making it difficult to reach agreements. The balance within OPEC is fragile, and past price wars have shown how easily things can spiral into chaos. Understanding these dynamics helps explain why Trump's request for increased production is far from simple. The global oil market is not just about supply and demand. It is deeply tied to geopolitics, national interests, and economic strategies.
Which, frankly, I'm surprised they didn't do before the election. That didn't show a lot of love. With oil prices going down, I'll demand that interest rates drop immediately, and likewise, they should be dropping all over the world.
Despite the rhetoric, the reality of American oil production is more complex. The U.S. is already one of the world's top oil producers, with record-high output in recent years. However, that doesn't mean we can endlessly drill without consequences. Oil executives emphasize that increasing production isn't just a matter of pumping more. It involves significant costs, regulatory hurdles, and market demands. The industry remains cautious, having learned from past booms that led to sharp downturns. Even with Trump's push for deregulation, changes in production levels won't happen overnight. It could take years to see a significant impact. So while the U.S. is producing a lot of oil, it's not a quick fix for lowering prices, debunking the myth of drill, baby, drill.
Drill, baby, drill.
Despite the rhetoric, the reality of American oil production is more complex. The U.S. is already one of the world's top oil producers, with record-high output in recent years. However, that doesn't mean we can endlessly drill without consequences. Oil executives emphasize that increasing production isn't just a matter of pumping more. It involves significant costs, regulatory hurdles, and market demands. The industry remains cautious, having learned from past booms that led to sharp downturns. Even with Trump's push for deregulation, changes in production levels won't happen overnight. It could take years to see a significant impact. So while the U.S. is producing a lot of oil, it's not a quick fix for lowering prices, debunking the myth of drill, baby, drill.
Mexico is going to reduce by 100,000 barrels.
This financial shift has reshaped the oil industry, with companies now prioritizing profits over sheer production volume. Rather than simply pumping more oil to meet demand, they are focusing on efficiency and sustainability. Investors expect strong returns, which means companies are being cautious, avoiding the reckless expansion that led to bankruptcies in the past. As a result, even with deregulation, a major surge in production isn't guaranteed. Producers must balance profitability with market realities. Meanwhile, Trump's strategy to persuade OPEC to increase production is ambitious. He aims to lower oil prices to curb inflation, but he's facing a tough audience. OPEC members, particularly Saudi Arabia, are reluctant to push prices down. While Trump's advisors argue that increased production could help stabilize prices, convincing OPEC is another challenge entirely. The interests of these oil-producing nations don't always align with U.S. goals, and OPEC ultimately operates on its own terms. For Saudi Arabia, the stakes are especially high. The country relies heavily on oil revenue to sustain its economy, fund social programs, and invest in infrastructure. If prices drop too low, it could create significant financial strain, making stability their top priority.
I don't know. I can't tell you. I'm going to Saudi Arabia.
Mr. President,
I've made a deal with Saudi Arabia because normally you'd go to.
They must balance their economic needs with global market pressures, making them hesitant to increase production at the request of external forces. Ultimately, Saudi Arabia prioritizes its own interests, and following Trump's advice could come at a cost. While the U.S. pushes for change, Saudi Arabia remains firmly focused on its own priorities. The U.S. versus Venezuela, a tale of two oil industries. When it comes to oil production, the contrast between the U.S. and Venezuela is striking. The U.S. is a powerhouse producing oil at record levels, while Venezuela's production has plummeted due to political turmoil and mismanagement. Despite possessing some of the world's largest oil reserves, years of corruption and economic instability have crippled Venezuela's ability to extract and export oil efficiently. The Venezuelan government nationalized its oil industry, a move that sounded promising on paper but has proven disastrous in practice. In contrast, the U.S. operates under a system where private companies drive production through profit incentives, fostering innovation and efficiency. However, this also means that the American oil industry is heavily influenced by market demands and investor expectations, leading to a more cautious approach to expansion. Current production levels and future outlook. At present, U.S. oil production remains at impressive levels, with millions of barrels being pumped daily. However, growth is expected to be modest in the coming years. While experts predict slight increases, they don't foresee a dramatic surge. Companies are prioritizing financial stability over rapid expansion, aiming to avoid the boom and bust cycles of the past. So while record production continues, significant jumps in output aren't likely anytime soon. The industry is adjusting to a new reality, one that emphasizes balance over unchecked growth. The impact of sanctions on global oil supply. Sanctions play a crucial role in shaping the global oil market. When the U.S. imposes restrictions on countries like Iran, the effects ripple across the industry. With Iran's exports restricted, other countries, such as China, are forced to seek alternative suppliers. This shift tightens global supply, often driving prices higher. It's a classic case of supply and demand, where sanctions can trigger unexpected market consequences. These dynamics highlight just how interconnected the global oil landscape is. When one country struggles, the effects can be felt worldwide. While sanctions may be targeted at specific nations, their broader economic impact can reach far beyond their intended scope. Jerome Powell's pushback against Trump. Federal Reserve Chairman Jerome Powell faces a difficult balancing act. Trump has been vocal about his desire for lower interest rates to curb inflation, but Powell remains cautious. He understands that cutting rates too aggressively could create long-term economic instability. His resistance signals a measured, careful approach to managing the economy, one that prioritizes stability over short-term political pressures.